Welcome to this explainer. We're about to take a seriously fascinating journey today. We're going to zoom way, way out to look at the massive, high-speed world of global currency markets, and then we're zooming right back in to pull up a chair at your local kitchen table. We're unpacking the fundamentals of foreign exchange and mortgage markets, drawing from the McGraw-Hill Financial Series to connect the dots between how global capital moves and how we actually, buy the roofs over our heads. Let's get into it.
Okay, let's dive right into this. Our agenda today is going to act kind of like a camera lens. We'll be covering 1. Global currency, 2. Winners and losers, 3. The anatomy of a mortgage, 4. The securitization machine, 5. The US versus Europe, and finally 6. What happens when the system breaks. All right, let's start wide.
Section 1. The global currency exchange. To kick things off, we really have to establish the breathtaking scale of the global financial neighborhood we all live in, because whenever money crosses borders, it enters the foreign exchange, or the FX market. Just look at this number, $7.51 trillion. And here's the crazy part. That is not an annual figure. That's the average daily trading volume of the FX markets as of 2022. I mean, think about that. Every single day, over $7.5 trillion is just sloshing around the globe to facilitate trade, investments, and hedging. It is a completely astronomical amount of capital. It literally dwarfs almost any other financial market on Earth.
But you might be wondering, where exactly is all this money moving? Well, notice the massive concentration here. The United Kingdom absolutely dominates, handling roughly 45% of all that daily turnover, primarily right out of London. The United States follows that up with 23%, and then it drops off really sharply down to Singapore at 7%. So to put that into perspective, nearly 70% of all global currency exchange is flowing through just 2 primary hubs. Wild, right?
Let's move to and see how this builds historically. For most of the 1800s, we operated on a gold standard. Back then, currency was basically just a paper claim on actual physical gold. Then, fast forward to 1944, the Bretton Woods Agreement came along and created a fixed rate system, pegging currencies within very, very narrow bands. But by 1973, they abandoned that whole setup, which created the partially free-floating system we use today. So now, the market largely decides a currency's value, literally minute by minute.
Now, when big institutions trade these currencies, they generally use 2 main methods. First, there's a spot transaction, which is exactly what it sounds like. You're exchanging currencies right on the spot, immediately at today's rate. But then there's a forward transaction. This locks in an exchange rate today for a delivery maybe months down the road. And remarkably, these forward transactions, which companies mostly use just to hedge against future risk, they actually make up a massive 72% of that daily $7.5 trillion volume.
Section 2, winners, losers, and risk. So we've got this partially free-floating system where trillions move every single day based on shifting exchange rates. Let's take a look at the practical reality of these massive macro fluctuations and how they create some very real ripple effects in our everyday lives. Now, what's really interesting about this slide is how a seemingly small economic shift creates immediate winners and losers. Just imagine the euro suddenly appreciates by 10% against the US dollar. Impartially speaking, European consumers and importing firms win big here, right? Because foreign goods and raw materials suddenly become way cheaper, which really increases their purchasing power. But on the flip side, European exporters and the tourism sector, they lose out. Their goods, their cities, they just became 10% more expensive for the rest of the world, which completely crushes their competitiveness.
And this brings us to a really fascinating question. We've been talking about trillions of dollars and massive macroeconomic forces. But where does all this global capital actually go? How does this completely unimaginable amount of global wealth eventually reach your own front door?
Section 3, anatomy of a mortgage. Let's leave the huge macro world for a second and zoom right down to the local kitchen table. We're going to meet Henry the homebuyer, who just walked into his local bank looking for a loan. So, Henry needs a mortgage, and fundamentally, a mortgage is really quite different from, say, a standard corporate bond. First off, it's backed by specific collateral, in this case, Henry's new house. Second, it's totally non-standardized. A bond is usually a nice, clean $1,000, but Henry's loan, it might be exactly $254,321. And finally, there is this huge information gap. I mean, it's super easy for an investor to go look up Apple's financials, but it's really hard for them to know if Henry is personally good for the money. And this brilliantly illustrates the heavy math Henry's facing right off the bat, the amortization schedule. If Henry takes a 30-year loan, his monthly payment sits at a pretty affordable $880. But if he decides to squeeze his budget for a 15-year loan at $1,095 a month, he saves a staggering $119,808 in total interest. So Henry's got to balance his immediate month-to-month affordability against these massive long-term interest savings. Now, Henry isn't alone in this metaphorical neighborhood. Different risk profiles get very different mortgage structures. Like the wealthy neighbor buying a massive mansion, they get a non-standard jumbo mortgage. The neighbor who has poor credit gets a subprime mortgage where they're paying a much higher rate just to offset that extra risk. And the senior citizen down the street, they might use a reverse annuity mortgage or a RAM. That's where the bank actually pays them every single month, and the bank only gets paid back when the house is eventually sold. Section 4, the securitization machine. So Henry signs his 30-year fixed-rate mortgage and just assumes his friendly local bank is going to be collecting his checks until he retires. But here is the really surprising truth. The local bank absolutely does not want to keep Henry's loan on its books. Holding on to a 30-year fixed loan exposes that bank to some serious long-term interest rate risk, and they do not want that. And this is exactly where the local kitchen table connects right back to those huge global FX markets we discussed earlier. It all happens through the securitization machine. Here's how it works. Step 1. The bank makes the local loan to Henry. Step 2. The bank turns around and immediately sells that loan to an agency like Fannie Mae. Fannie Mae then takes Henry's loan and throws it into a giant blender with thousands of other loans to create a mortgage-backed security, or an MBS. Finally, Step 3. That newly blended smoothie of local loans is sold off to global investors. If we trace who actually owns U.S. mortgage debt at the very end of this securitization process, the data is pretty staggering. The local banks? They're barely even in the picture anymore. Over 75% of all mortgage debt is held by massive entities. Federal agencies hold 38.3%, and major global financial institutions hold 37.1%. So your local house keys are quite literally resting in the portfolios of global capital markets. Section 5, U.S. versus Europe. Now, it's vital to realize that this whole securitization machine isn't just some universal law of physics. If we broaden our perspective a bit, we can see exactly how two different continents handle this exact same housing and finance challenge in completely different ways. So the crucial point here is the sheer difference in scale. In 2021, the United States issued $2.9 trillion in securitized assets. Meanwhile, all of Europe combined issued only $197 billion. The American financial system is overwhelmingly built on this idea of bundling and selling debt globally, whereas Europe relies on a fundamentally different structure. Here's the contrast between the two. The U.S. uses an originate-to-distribute model. Lenders make loans specifically to sell them, which creates a highly liquid, standardized market. And that's exactly what allows American borrowers to lock in those 30-year fixed-rate mortgages. Europe, however, largely uses an originate-to-hold model. European banks are much more conservative. They actually keep the loans on their own balance sheets. Because the banks are holding that long-term risk, they protect themselves by issuing variable-rate mortgages. Which means when central banks raise interest rates, the European homeowner feels that pressure immediately on their monthly bill. Section 6, when the system breaks. So what we have here are two vastly different systems tying local homes to macroeconomics. But what happens when the local and the global systems collide violently? Like, what actually happens when that securitization blender malfunctions? Well, we saw exactly what happens during the 2008 financial crisis. Banks had originated way too many of those risky, toxic subprime loans and just kept feeding them into the global securitization machine. So when the housing bubble popped and everyday homeowners started defaulting on their mortgages, it didn't just hurt the local banks. It poisoned the global mortgage-backed securities held by investors worldwide. This completely froze the entire global financial system and forced the U.S. government to step in with billions just to save agencies like Fannie Mae and Freddie Mac. The source material actually summarizes this beautifully with a super powerful analogy. They say a leak in one house can cause a flood that drowns the entire world's economy. Because of the incredible scale of the global foreign exchange and securitization markets, the financial health of an everyday homebuyer is completely, inextricably linked to the portfolios of these massive global institutions. Which leaves us with a final, really vital thought to ponder. We've seen how trillions flow daily across oceans. only to end up financing the house at the end of your cul-de-sac. Our macro and microeconomic ties are absolute at this point. But looking at the system today, we really have to ask ourselves, are our global bridges fundamentally stronger now than they were in 2008, or are we simply building different toxic smoothies? It's a question that dictates the entire future of global finance. I hope this explainer has given you the lens to see how it all connects. Keep learning and keep questioning.